There are two parts to the capital budgeting process. First, we need to estimate the discount rate, the weighted average cost of capital, and the second part is estimating the incremental free cash flows. These free cash flows are made up of three items: the initial investment, the annual free cash flows, and finally the terminal value. Let's start with a quick review of the weighted average cost of capital. WACC, or weighted average cost of capital, is equal to the required rate of return on debt times 1 minus the tax rate times the percent debt, plus the required rate of return on equity times the percent equity. In this case, KD is equal to the required rate of return on debt, the percent debt is equal to percent debt in the pool of funds, T is equal to tax rate, K sub E is the required rate of return to equity, and the percent equity is the percent of equity in the pool of funds. In this note, we'll be focusing more on the second step, estimating the incremental free cash flows. For a full discussion of weighted average cost of capital, please see the WACC tutorial. Let's look at the different components of the free cash flow in more detail. The initial investment typically would include things like the purchase of a new asset, any investment in net working capital, and possibly the after-tax effects from the sale of an old asset. Incremental free cash flows are made up of the change in net operating profit after tax, plus the change in depreciation, minus any change in capital expenditures, and minus the change in net working capital. We'll explore this in more detail a little bit later. The sum of all of these is the change in the free cash flow. The last item is terminal value. Typically, the terminal value would include things such as the after-tax proceeds from the sale of the asset and any recapture of net working capital. Let's look at an example to demonstrate some of these concepts. Grainger Corporation is considering a new product. They project that the new product will have sales of $3 million the first year and then are expected to grow at 5% for the next 4 years. They will have to add new equipment at a cost of $1.927 million, which will be depreciated on a straight-line basis to a zero salvage value over 5 years. It is estimated that the cost of goods sold will be 73% of sales, SG&A will be 11% of sales, and that net working capital for the project will be about 8% of sales. At the end of 5 years, the project will be terminated and all net working capital will be recaptured, and the equipment will be sold for an estimated price of $500,000. Grainger's tax rate is 30%, and its WACC is 10%. In estimating the incremental free cash flows, we'll need to deal with all of these items. We start with the initial investment. The first item is the cash outlay for the new investment. The second item is the investment in net working capital. Net working capital is defined as current assets excluding excess cash minus current liabilities excluding interest-bearing items. Note that we often express current assets and current liabilities as percentages of sales. Hence, it's easy to see how the difference between the two, net working capital, can be also expressed as a percentage of sale. Here, net working capital is estimated to be 8% of sales. If we also assume that we need to make the investment of net working capital at the beginning of the period, we will need the $240 in net working capital to support the sales in year one as part of the initial investment. Note that in subsequent years, we only need to fund the change in net working capital. We have also included as part of the initial investment the possibility there could be a sale of an existing asset to offset the initial investment. However, that is not the case here. As such, the total for the initial investment is $2,167,000. Next, we need to estimate the incremental free cash flows for the project. We need the change in NOPAT, change in depreciation, the change in capital expenditures, and the change in net working capital. The sum is the change in free cash flow attributable to the project. Here we have laid out the estimates of the incremental free cash flows for the project. We have sales, cost of goods sold, and SG&A. Depreciation is equal to the $1.927 million divided by 5 for a total of $385.4 per year. The sum of all of this is the EBIT. Remember, in calculating NOPAT, we exclude interest. As such, taxes are determined by multiplying EBIT times the tax rate of 30%. After deducting taxes, we get NOPAT. Next, we need to add back depreciation for years 1 through 5. Only capital expenditure in this instance is part of the initial investment. Next, we need to account for any changes in net working capital. We assume that we need the net working capital at the beginning of the year. Net working capital each year is shown here. The change in net working capital is also shown. Note that the net working capital for the first year's sales is included as part of the initial investment. In years 1 through 4, we need to deduct the change in net working capital. Note that we will account for the recapture of net working capital as part of the terminal value. Finally, the sum of these is the free cash flow for each year. Now let's do the terminal value. The terminal value in this case has two parts, the sale of the asset and the recapture of net working capital. For the sale of the asset, the sales price is $500,000. However, there will be taxes due on this sale. With a sales price of $500,000 and a book value of 0, the taxable gain here is $500,000. Assuming a tax rate of 30%, the taxes due on the sale would be $150,000. The after-tax cash proceeds from the sale of the asset then would be $500,000 minus $150,000 in taxes for a net cash proceeds of $350,000. The next item is the recapture of net working capital. Here we will assume that we recapture the ending net working capital of $291.72. Note that there are no tax effects for the recapture of net working capital. Assuming that we recover all operating cash, collect all accounts receivable, sell off inventory, pay off accounts payable and accrued expenses, all at book values, there will be no tax effects. Now we can put it all together and calculate the net present value. We have an initial investment of $21.67, free cash flows for years 1 through 5, and the terminal values for the sale of the asset and the recapture of net working capital. We take the present value of each of the total free cash flows. The sum of all present values is $2190.60. Hence, the difference between the value of the project and the cost is the NPV of $2360. The NPV is positive, so this project is a value-creating project. There are 3 steps associated with estimating the free cash flows for a project or investment. First, we estimate the initial investment. Next, we estimate the annual free cash flows. And finally, we estimate the terminal value. In addition to these, there are a couple of other steps to estimate the NPV of the project. The first is to discount the free cash flows and terminal value at the weighted average cost of capital to get an estimate of the project value. And the final step is to estimate the NPV by deducting the cost from the value. A key concept is the idea that our analysis should focus on the incremental cash flows associated with the project. In the prior example, all of the cash flows from the project we treated as being incremental. Let's look at a broader example of what we mean by incremental analysis.